Here's a riddle. The price of milk is up. The price of bread is up. Your salary? Flat. The economy is shrinking. But your grocery bill? Still climbing. This is not a recession. This is something far more sinister. Let me hit you with the numbers that nobody in the mainstream media is talking about. GDP growth just fell from 4.4% to 0.5% in a single quarter. That is not a slowdown. That is a collapse. 1 quarter. From 4.4 to 0.5. Meanwhile, consumer prices jumped from 2.4% to 3.3%. The last time America saw numbers like this? Gerald Ford was president. And the Fed just left interest rates unchanged at 3.75%. This, my friends, has a name. Stagflation. Stagnant economy plus inflation. GDP going nowhere. Prices going up. And here is the kicker. The Federal Reserve, the most powerful institution in global finance, cannot solve this problem with their usual toolkit. Not with rate cuts. Not with stimulus spending. They are trapped. To understand why this is happening now, we need to go back to where it all started. Stagflation last visited America in the 1970s. Back then, OPEC cut off oil exports to the West. Prices at the pump hit record highs. Nixon froze wages. Carter watched the misery index climb. Millions of Americans lost their jobs. It took Paul Volcker slamming interest rates to 20% to finally break the back of inflation. And that came with a brutal recession. Sound familiar? Today, we face a different trigger. But the same trap. The 1970s crisis was about oil. Today's stagflation triggers are threefold. 1. Global supply chain restructuring is making everything more expensive to produce. 2. The labor market is still historically tight, keeping wages elevated. 3. The energy transition is hitting production costs across every sector simultaneously. From groceries to electricity bills to transportation costs. The result is the same. But the reasons are different. So why doesn't the Fed just cut rates? Because cutting now sends a signal. A signal that inflation is winning. Markets panic. The dollar weakens. Prices climb even higher. And here is what nobody in the mainstream financial media is telling you. The Fed funds rate at 3.75%. That is historically very low for a stagflation environment. In the 1970s, Volcker had to go all the way to 20%. To finally kill inflation. Where do rates need to go if inflation refuses to cool? Cut rates to help the economy grow. Then inflation explodes further. Prices of everything from rent to groceries to gas keep climbing. Workers demand higher wages to keep up. Wages chase prices. Prices chase wages. This is the classic 1970s wage price spiral. Once it starts, it is incredibly hard to stop. Raise rates to kill inflation. Then companies stop investing. Hiring freezes. Unemployment climbs. And the Fed has to engineer a recession to break inflation's back. That was Volcker's playbook. And it worked. But not before millions of Americans lost their jobs. Now here is the uncomfortable truth that Wall Street does not want you to hear. While GDP is crashing and prices are climbing, the S&P 500 is sitting at 7,165. Near all-time highs. Stagflation does not always crush stocks. Not immediately. Not when a handful of AI megacap companies are carrying the entire market on their backs. The stock market is not the economy. Right now, they are telling completely different stories. And here is another trap that most financial advisors will not mention. Bonds are supposed to be safe during recessions. But stagflation is not a recession. When inflation runs at 3.3%, a bond yielding 4% gives you just 0.7% in real returns. After taxes, you might actually be losing purchasing power every single year. The safest asset on paper is quietly stealing from you. Historically, gold has been the stagflation winner. When Nixon ended the gold standard in 1971, gold went from $35 to $850 by 1980. That is a 24 times return in 9 years. Today, gold is already breaking records. And unlike stocks, gold does not care about interest rates or corporate earnings. It only cares about one thing: trust in the financial system. And in 2026, trust is eroding. So what does all of this mean for your portfolio? 3 moves. First, hold some gold. Not 50%, not 30%. But 5 to 10% as insurance against currency debasement. Second, reduce long-duration bonds. Their fixed coupon payments lose real purchasing power in a stagflationary environment. Third, and this is counterintuitive, consider equities in sectors that actually benefit from inflation. Energy companies. Commodity producers. Companies with strong pricing power that can pass rising costs directly to customers. Avoid growth stocks with sky-high valuations that depend on low interest rates and endless earnings expansion. Stagflation kills that investment narrative. The big takeaway today: stagflation is not a recession. It is a completely different economic animal. The playbook is different. The winners and losers are different. And the biggest risk right now is not the economy itself. It is complacency. Markets can ignore bad economic news for months, even years, before the bill finally comes due. History suggests the bill always comes. Here's my question for you. If you had to choose between 2 economies, a 10% raise with 8% inflation, or a 3% raise with 2% inflation, which economy would you rather live in? Drop your answer in the comments below. And if you found this breakdown useful, smash that subscribe button. I'll keep breaking down the economics hiding in plain sight. Economics is everywhere, if you know where to look. Now you know where to look.